This is the market and economic update call to go alongside of our newsletter that goes out on the third Tuesday of every month. So my name is Ashley Micciche, and I'm here with our founder and president, David Wilson, who is in California right now. How's the weather down there?
80 degrees and beautiful. I'm staying for a little longer.
So we're having this call. We normally film the video in our office, but since Dave is in California for the next couple months, we are filming this call. So thank you so much for watching this video. The purpose of this video is just to give you kind of a high-level 30,000-foot view of what's going on in the economy, what's going on in the markets, and as a result of that, how do we need to be acting? What do we need to be doing? How do we need to be positioning portfolios? What's important for you to think about in the current environment that we're in? So the purpose of all of this is, not to have it be another, talking head CNBC show, but we really want to take all of everything that's going on right now in the world and distill it down into what matters for you and your portfolio. So why don't we go ahead and start just by talking about where the economy is at right now?
Well, I think we've got a couple of things going on. The economy is still growing at a nice pace. I think the market was worried about corporate earnings, and they've come in surprisingly well. So that kind of took that off the table. Every day that goes by, it seems that there are more tidbits that come out about the imminent trade deal with China, and the Fed continues to be on pause. So those are kind of the three main drivers to the market, and together they've led the market to an 18% gain just since Christmas. So there's still a lot of positive going on.
Yeah. So I was just looking. S&P 500 is up 11.4% year to date already. And as we record this, it's early March. So, it's funny because I think a lot of clients, I'd certainly be happy if the market went nowhere from here for the rest of the year because it's already had a nice gain. So why don't you talk a little bit about some other things that are driving markets and kind of where you see markets heading for the rest. I mean, is everything baked in? Should we just, sell? And how should investors be reacting to what's going on out there?
Great question, Ashley. I think some of it is baked in. I think market participants are anticipating that we get some sort of trade deal with China. I think that's actually going to lead to the next leg up, because what I think is going to happen is that if we do get a trade deal, yeah, there probably will be some profit taken at that moment. But I think after that, I think we will get what I call the next leg up. And that next leg up was because you're going to take that uncertainty off the table. You're then going to have investors and companies will then be making investment decisions, hiring decisions, knowing that there aren't going to be tariffs or there are going to be other, they don't have to worry about like I say, these trade tariffs. So those things, are going to really calm the market down and allow companies and businesses to forecast and do hiring and investment that they were kind of uncertain about before. So it takes, an additional thing that we've been worried about for the last 18 months off the table, and I think again will propel the market forward.
Mm-hmm. So I know one of the questions I get asked all the time from clients is, when are we going to slip into another recession? And I know neither of us have a crystal ball, but I think what's so unusual about this, and I know we've talked about in the past, is that if we make it, I believe if we make it to May or June, I think it might be June.
It's actually the market hit bottom March 9th.
No, well, I'm talking about the economic expansion, though.
Yeah. I think
if we make it to like late spring, early summer, it will be the largest economic expansion in the history of the United States. So very, extended, unprecedented, long extension. I think we usually have a recession every 5 to 7 years, and here we are. We're well past that at this point. So I think the longer that this goes on, the more worried that clients become, or investors become, that hey, maybe I really need to protect myself because this next recession is imminent. So what are your thoughts about the timing and of the next recession, and does the market and the economy still have room to grow?
I don't know who said it. I think somebody said economists have correctly predicted 9 of the last 3 recessions or something like that. I don't know the exact quote, but the problem is that they're looking at historically what's happened, and the Great Recession was something very, very unique. I mean, we haven't had anything like that since the Depression. We came out of that growing at such a slow pace. In other words, usually when you have a recession, the market rebounds and the economy picks up dramatically, and then you have the normal business cycle. But what we had here is it was a slow, plane barely took off and just barely got the, cruising altitude. So the thing is that's why I think this is probably going to break the record and maybe go for a couple more years, because we did go at such a slow rise, and you didn't have these, rocket ship economic recovery. It was just a slow grind, and we're still in that. So, and I think these tax cuts that we did get, the capital investment has been very strong. Those tax cuts just went into effect, last year. So I think we're still in the beginning phases of that. And these people who are predicting a recession, I think they're a little bit premature. I mean, there's inverted yield curve you look for, and there's other examples. We're just not seeing them yet. So, and unless that's there, you're kind of premature forecasting that stuff.
Yeah. Well, and I know one of the things that I definitely wanted to talk about that we also talked about the last couple months is protecting client portfolios in this environment. So one of the main themes that I think is really important to talk about is, we've had this huge run up. I was just looking, the S&P 500 over the last 5 years is up 50%, almost 50%. So we've had client portfolios, and while we've rebalanced along the way, as the market continues to go higher, it's very important to look at your allocation. How much in stocks do I have? How much in bonds do I have? And even drilling down a little bit further than that, are you concentrated in any one particular area? Do you have too much in international, too much in large cap or small cap, or whatever that may be? And I know that's something that we're always doing as part of the regular reviews. But I think where the opportunity exists right now, and you and I have talked about this a lot of times, but where the opportunity exists right now is taking advantage of this growth. The market's up almost 50% in the last 5 years. It's already up 11.5% this year. So it's very important to say, okay, if you should be 60% in stocks and you're 65% in stocks, now we need to take the opportunity in this current market environment to reduce what you have in stocks and get that down to where you should be, so that when the next recession comes, when the market goes down 10, 20, 30%, whatever it ends up happening, you'll be insulated from that, and you'll have taken money off the table while the market was high, while you had the opportunity to do so. So I know that's a huge area of focus, and one of the main investment themes that we talk about over and over again is evaluating your asset allocation, making sure that it's aligned with where you should be, primarily for your age, but other factors as well. And then, being disciplined about reducing that. And I don't know, if you maybe want to speak to, I know sometimes when the market's going well, clients are like, no, I don't want to redo. Why?
Right.
Why would I?
No, I've had this conversation. So earlier in the year, I said, oh, we get up 7-8%. I want to, adjust your allocation. Oh, yeah. Everybody says, yeah, that's great. Let's do it. And now we're up 11%, and I call people up, and everybody, well, let's wait till the China deal comes. There's more ups. So the thing that I'm trying to do is, in some cases, I will, if let's say you need to be at 55% in your allocation, use 65%. I definitely take back 5% right now, get down to 60, and then if we get a trade deal with China and we have another leg up, then you do the other 5% to get you down. So you could do it in stages. I'm not afraid to do it to get down to a level. If we're only talking a few percent, I think you could do it right now. But the reason we do it is we want people positioned in case we do have something. We've had a very long, even though we did technically touch 20% down in that last quarter last year. So technically it was a bear market, but we came out of it so darn quickly. And it seems like we've done this a couple times and the market goes higher to new highs. I think it's just prudent that as you get close to new highs, that you take a little bit off, you adjust your allocation so that if we do have something that is kind of outside the box that people don't expect that happens, that causes the market to go down, you could have a war, you could have a disaster, or, who knows, the market could pull back, and maybe even like when we had the 9/11, right after that, we went into recession. Yeah. So you could have something that occurred, and so you want your portfolio position. So do it when times are good. Don't do it after the market has pulled back 10%, and then you want to reduce your allocation. You're just hurting yourself.
Right. Okay, so we've talked about the economy, the drivers of that. It's getting pretty long in the teeth, but again, there's still a lot of reasons to be positive. Markets are obviously very strong this year. And then, as far as the investment themes, we've talked about asset allocation, being disciplined about reducing that if necessary. What are some other investment themes that you see in this environment?
I think the two that I think we're adamant about is one is a laddered bond portfolio, because it looks like interest rates are kind of stuck in this kind of, it looks like they were going up, and now they've we went to 3% on the 10-year, and now we're back down to 2.7.
Yeah, so I noticed that across the board where, I look at money market yields, bond yields, they've actually come down a little bit.
Yeah. So I think the laddered bond portfolio, I could get 4% in like a 6-year corporate bond. I can get 2 3/4 in a 1 or 2 year CD. So, the yields, depending on how far out you go, are going to be kind of in that ballpark. And so I think that's still sound in this environment with really no inflation to speak of. And then I think the rising dividend stocks, which give you an increasing flow of income in retirement, protect you to some extent if we do have a downturn, and I think give you the best way to grow capital. So those two, I think, are the ones that I would continue to stick with.
Yeah. What about international or small and mid cap right now?
Yeah, I think small and mid cap are still solid because those tax cuts still are flowing through to smaller companies, and they can benefit from that. International is a little bit more problematic because China's still in a slowing period. Europe is weak. So you have these pockets that, are not as strong as the U.S. I mean, we're kind of the best place to invest right now. But we still have some allocation overseas because those valuations are still a lot lower than, let's say, ours are. So that makes them look attractive from that standpoint. But I'm not going hog wild on international.
Yeah. Well, it's always challenging because international does look very cheap right now, as on sale, a good time to buy. But international has also been very cheap and beaten down since since 07, 08, for the last 10, 11 years. So, and it's had, runs up too, but in general, it's been a rough place to be for the last decade or so. But on the long-term side, there's still a lot of opportunity outside of the United States, where you have these developing markets around the world where the consumer for the first time, is getting a refrigerator and they're, ordering things online, and the consumer, so these other nations like China are slowly becoming more free, and their consumers are financially able to buy more things. So there's a lot of opportunity that I think exists around the world, but it's not going up in like a straight line. It's very up and down.
I mean, like year before last, the international was up 25-30%. Then last year it got kicked in the teeth. So, that's why you have to be careful how you do it. And you can also invest in international companies that are, let's say, they might be domiciled overseas, but they're, well known to you and I and everybody else. But, most of their business maybe here is in the U.S., or you buy, American products that are here, but are sold overseas to that growing middle class. So there's a lot of ways to do it.
Yeah. Okay. Well, good. So do you want to wrap up and talk about kind of what the bottom line is and what the key takeaway is? The bottom line
is, I think that I'm looking for a pause here, because maybe until we get some sort of announcement of, trade deal, because the market has gone up very rapidly. So pulling back a couple percent wouldn't surprise me. I think once we get a trade deal, I think initially you might have a little profit taken, but I think then we will. I'm expecting a second leg up, and again, I would use that to adjust my allocation and look at areas where I might be overexposed, or my allocation, or I got a position that's too concentrated that I need to reduce. So it's a great time to, look at your portfolio and make sure it's how you want it to be positioned.
Okay. Well, good. Anything else?
It looks like you have nice weather up there. I hope, what's it, 35 degrees out?
It's windy and about 39, but it is sunny. Yeah.
Well, anyway, you enjoy.
Okay.
And
hold on, I want to say one more thing. So, thank you so much. Thank you so much for watching. My name is Ashley Micciche, and I'm here with our founder and president, David Wilson. And we are so thankful that you have watched this video today. If you like this video, please give us a thumbs up, and please tune in. Subscribe to this channel, and you'll be notified of new videos that come out every single week. We talk about what we're talking about today, the markets, the economy. We also talk about very planning specific topics in terms of exiting your business and planning for a successful retirement. So you can go back to our archives. We've talked about Social Security, required minimum distributions. We cover a lot here. And so if you like this video, please like, comment, and subscribe. So thank you so much for watching, and we hope you have a great day.